It may seem strange for a buyer's agent to say this, but you can lose money in property. And not just when the market slows down, but at any time. There's a report that comes out every 3 months by Corelogic, and it's called the Pain and Gain Report. That's right, pain and gain. Now, I've been reading these reports for some years now, and I've learnt that close to 10% of property sells for a loss in Australia every single quarter. Here are some of the general patterns that I've noticed. More apartments sell at a loss than houses, which is largely due to the high proportion of new apartments that lose money on resale. More investors sell at a loss than owner-occupiers, which is probably due to them being more sensitive to losses than owner-occupiers. More regional properties sell at a loss than those in the city, which would have been exacerbated in recent years by crashes in mining towns. Even if you sell for more than you paid, that doesn't necessarily mean that you made any money. You need to subtract all of your costs of ownership in order to determine whether or not you actually made a profit. And then you need to think about what else your money could have been doing over that period of time instead. Opportunity cost is one of the biggest ways you can lose money on property. Now, here are 7 ways that you can easily lose money on property. Number 1, you buy off the plan. People don't realise that they are paying a premium for brand new, and that a lack of scarcity and a full development pipeline will impact growth. Now, research has shown that more than 50% of new apartments bought and resold in Melbourne between 2011 and 2016 actually sold at a loss. Number 2, you pay too much at the peak of the market. Now, when the market's hot, buyers panic and often pay too much. If, in your hurry to get on the property ladder, you overlook the negatives of a property, you could end up buying a lemon, one that goes down in value even while others go up. Number 3, you fail to act on good opportunities. When the market slows down, people say, we'll wait and see if prices fall. Now, savvy investors take advantage of a buyer's market and have the confidence to secure quality property at reasonable prices. Some of those who bought just after the GFC reaped gains in a very short period of time. Number 4, you get conned by a property spruiker. Now, my heart breaks when I hear of people falling for the spin of investment advisors. Now, these are people that are really just trying to sell you a get-rich-quick scheme. Now, if you aren't paying for the advice, it's probably a sales pitch. The developers and the marketers will make money, but not you. Number 5, you chase quantity over quality. It's incredibly risky to try to buy too many too fast. And when positive cash flow is more important than capital growth, you run the risk of buying underperforming assets. Your rent needs to be really high to compensate for the lack of capital growth. Number 6, poor property choice. Owner-occupiers are the people that push up prices, not investors. So it stands to reason that a property that appeals to owner-occupiers will be more popular than investor stock. If you buy a property that appeals only to investors, your opportunity for capital growth is limited. And number 7, you buy in the wrong location. Some areas offer sustainable growth, and others are up and coming, and yet others are in various stages of the property cycle. And property investment is a long game, and your choice of location needs to take into account your long-term goals and your appetite for risk. If you're looking for the next hotspot, you need to make sure that you keep your eye on the location so that you sell before the market starts falling. Now, I don't want to scare you off buying property. I just want you to be aware of the risks so that you can take due care when you buy. And my mission is to help you make good property decisions. If you'd like to know more about buying a low-risk property, then download my free ebook. The link's in the notes below. Now, if you like this video, please click like and also share it.